In June 2026, Microsoft experienced a monthly capitulation, erasing over $530 billion in market value. The sell-off was violent, pushing the stock down 21.6% to an intraday low of $349.20. Yet this technical breakdown occurred alongside strong operational execution. Commercial cloud revenue reached $54.5 billion, a 29% year-over-year increase. Azure and other cloud services accelerated to a 40% year-over-year growth rate in constant currency. Investors are currently repricing Microsoft's business model as it shifts from software to infrastructure. Throughout the Satya Nadella era, Microsoft operated as a predictable software-as-a-service compounder, a high-margin, asset-light business that converted subscriptions into steady cash. That model is being replaced by a capital-intensive, hardware-dependent AI infrastructure strategy. Even with strong AI demand, the market is penalizing the stock. Investors are showing deep signs of capital intensity fatigue. Much of this pressure stems from the widening gulf between reported net income and the actual distributable cash flow. This reflects the financial friction required to construct a global footprint of energy-intensive AI data centers. Microsoft has guided its 2026 capital expenditures to $190 billion, a 61% expansion. This alters the balance sheet. In 2023, capex took 41% of operating cash flow. Now it's projected to consume up to 100%. Bringing this capacity online triggers massive depreciation charges. These pressured third-quarter consolidated gross margins down to 67.6%. The lowest level since 2022. The accounting pressure is compounded by supply-side inflation. Chief Financial Officer Amy Hood confirmed that rising hardware costs are eroding the efficiency of this spending. Specifically, $25 billion of that $190 billion budget is tied to component price inflation, particularly memory. That $25 billion generates zero incremental compute capacity. The result is visible on the balance sheet. Third-quarter free cash flow contracted by 22%. These risks are underscored by an April 2026 contract amendment that dissolved OpenAI's hosting exclusivity on Azure and capped Microsoft's revenue share payments at $38 billion through 2030. Market anxiety is further fueled by a federal securities class action, alleging that the Copilot product suite suffers from interoperability failures and poor user retention. Investors across the market are currently discounting the stock to heavily account for these unquantifiable credit and counterparty risks. The June sell-off compressed Microsoft's valuation multiples, driving forward PE down to 19.3. A forward PE of 19.3 is a sharp discount. It sits below the broader S&P 500 average of 24.4 and well under Microsoft's 5-year historical median of 34. Historically, a forward multiple below 20 has signaled a reliable cyclical bottom as the market temporarily discounts the durability of enterprise cash flows. During the deepest point of the June drawdown, macro investor Michael Burry disclosed a highly leveraged Contrarian long position. Burry purchased December 15, 2028 leap call options with strike prices in the low $700 range. Burry argues the sell-off is a technical liquidity rotation, a momentum-driven pivot into semiconductors that disregards Microsoft's operational strength. By utilizing long-dated options, Burry is betting that the market has mispriced the duration of Microsoft's cash flow impairment. Microsoft retains a robust defense mechanism. It generates approximately $100 billion in annual net income with a 39.3% net margin. The firm maintains a AAA corporate credit rating and a resilient negative net debt to EBITDA ratio of negative 0.21. Unlike smaller hyperscalers who must issue dilutive equity or access debt markets, Microsoft is self-funding this entire infrastructure transition. By absorbing the $190 billion build-out through internal operating cash flow, Microsoft shields its long-term return on capital from external borrowing costs. To find Microsoft's intrinsic value, we must map the recovery of its margins through an institutional discounted cash flow model. Using the capital asset pricing model, combining a 4.25% risk-free rate, a 0.95 beta, and a 6.00% equity risk premium, produces a 9.95% cost of equity. Adjusted for negative net debt, this establishes a 9% weighted average cost of capital. Stage 1 covers years 1 through 5. Upfront outlays and GPU depreciation depress cash flow margins to 22 to 25%. In Stage 2, years 6 to 10, capex drops to 15 to 20%. As assets amortize, margins expand to 35 to 38%. Applying a conservative terminal exit multiple of 22 to these cash flows establishes the valuation floor. The market panic is mathematically flawed. It incorrectly extrapolates temporary Stage 1 capital friction into perpetuity, missing the self-funded inflection point that expands cash flow.